This LOS is describe how the cash flow statement is linked to the income statement and the balance sheet. Direct and indirect methods for reporting cash flow from operating activities. So let's just start with the accounting equation, assets equals liabilities plus equity. Well, cash is an asset. The statement of cash flows ultimately shows the change in cash during an accounting period. The beginning and ending balances of cash are shown on the company's balance sheet for the previous and current years, and the bottom of the cash flow statement reconciles beginning cash with ending cash. So that's a link between the cash flow statement and the balance sheet. Then we use the T accounts to often calculate the movements in cash, okay? So this is just the quick example using accounts receivable. We have our opening balance. That's given from the balance sheet. That is the end of last year, is the beginning of this year. Plus our credit sales minus our cash collections is going to be our closing balance for accounts receivable. Because remember, if I have my cash account here and I collect my accounts receivable, it's going to be debit cash and credit my accounts receivable, okay? And so therefore, this is given on the balance sheet, this is given on the balance sheet, and this is given from the income statement. So that's a link between the income statement, the balance sheet, and the cash flow statements, okay? And this is kind of what they're talking about with regards to this LOS. So then with our T accounts on the balance sheet, given any three, we can calculate the fourth, and that's what we're doing with our T accounts. The change in the balance sheet account equals the cash collected. And we can do that for accounts payable as well. If we look at our payables, we have our opening balance from the balance sheet, we have our closing balance from the balance sheet, we have additions to the account from the income statement, and therefore we're going to credit cash and debit a payable. We can see what the cash out was by the change in the balance sheet accounts. Now there's a 23-minute video with regards to cash flows. I go through an example in Excel, and so there's more information on that in that video. So this is the last slide for this LOS. And again, we're just going through, I have the T account for assets and I have the T accounts for liabilities. So we can see for asset, the normal balance is a debit balance. Any debit to an asset account increases it. So inventory, for example, credit cash, debit inventory, that's an increase to the inventory, that's the normal balance. And any credit will decrease the balance. So same thing for cash, any debit to cash will increase the balance, any credit to cash will decrease. So over here I said, when increasing an asset, it's a use of cash, it's a negative. So example, increase inventory, debit inventory, credit cash. When decreasing an asset, it's a source of cash, it's the positive. So example, decrease accounts receivable, debit cash, credit accounts receivable, that's decreased my accounts receivable, it's a source of cash, okay? On the liabilities, our normal balance is a credit balance, debit inventory, credit accounts payable, for example. And when I go to pay that payable, it'd be credit cash, debit accounts payable, that would decrease my liability, okay? So when decreasing a liability, it's a use of cash, it's a negative. So just as I gave my example, decrease the accounts payable, debit accounts payable, credit cash, use of cash, negative cash, okay? And when increasing a liability, it's a source of cash, it's a positive. So an example, a note payable. I buy some equipment, but I don't pay for it right away. Or I've issued some type of note. In this case, debit cash, credit the note payable. My note payable went up, my cash went up, so it's a positive. And that's the last slide for this LOS. Thank you.